Do you want to start investing in the financial market but don't know where and how to start? Here's a 10-step investing series for you to help you get started. The first step is to educate yourself on some basic principles about investing and finance in general. Don't start investing without having some basic knowledge about what investing is, what finance is, and what the financial market is. I'm not talking about the technical details of what investing or finance is all about, but I am talking about key principles in finance or investment, things like compound interest, the bond market, share price, dividends, diversification. All these are very, very important concepts in investment that every investor ought to know something about them. So as a beginner investor or somebody who wants to start investing, start by educating yourself, acquiring knowledge about these things, and that will help you start your investment journey with confidence. The second step is to clearly define your investment goals. Why do you want to invest in the first place? Do you want to invest short term or long term? How long can you wait in the market? So these are questions you need to ask yourself before you start to invest. Clearly defining your investment goals will help you to identify the kind of investment instruments you want to invest in. For example, let's say I have a lump sum of 50,000 Ghana cedis in my savings account, but I want to use that money next year to start a business or to start a building project. So I don't want to raise my money so much. And at the same time, I don't want to keep my money in my savings account, which only attracts very little interest. So I want an investment that will preserve my capital and at the same time give me an interest rate that is relatively higher than the interest rate my savings account gives me. What should I do? In this scenario, it will not be a prudent idea to go and buy individual stocks because we know that the stock market is highly volatile. That can expose your capital to short-term volatility. So what will you do? Maybe the best thing to do is to consider investing in short-term instruments like treasury bills that is able to preserve your capital and at the same time give you an interest rate that is relatively higher than the rate that your savings account will give you. So clearly defining your investment goals this way will help you to start your investment journey with clear confidence. The third step is to pay off your very high interest debt first. Why is this important? I will give you an example. Let's say you have a loan that has an interest rate of 25%, and you are also considering investing in a financial instrument that has an average rate of return of 15% per annum. That's a 10% gap between the two. Very, very significant. What that means is that in the event that you don't pay the debt, the rate at which your debt will accumulate is higher than the rate at which you will gain interest on your investment. And this will have a negative effect on your long-term finance. So paying off your debt first will help you gain financial space to invest with confidence and with understanding. However, I am not saying that you cannot invest once you owe. What I'm saying is that paying off your high interest debt will help you to invest confidently. If you are owing, you can always find a balance between paying the debt and investing. But to the effect that the interest rate on the debt is very high, paying the debt off first is to your own advantage in the long run. The fourth step to take is to build an emergency fund, which I'll be explaining in detail in one of my videos. What is an emergency fund? It is simply an amount of money you set aside for any emergency, such as a job loss, without having to sell assets or belongings to meet that emergency. One mistake that most beginner investors do is to invest all their money into buying assets, specifically financial assets, without building a buffer. And in the event of any emergency, they go back to selling those assets to meet the emergency. And in most cases, you are likely to sell your assets at prices lower than the price you bought them because of short-term volatility. So that is why it is very important to have an emergency fund based on your income and expenditure so that you can give your investment some time to grow in the market. In this way, you will not have to sell your financial assets to meet short-term emergencies. The fifth step to take is to review your income and expenditure. How much do you earn in the month and how much do you spend in the month? So let's assume that you earn 5,000 a month and you spend around 2,500. It means that you have 2,500 left. So how much of that amount will you be able to dedicate into investing in a financial instrument? So sitting down and analyzing your income and expenditure will help you to take realistic investment goals. It will also help you to sustain your investment journey such that you will not have to start and along the way not be able to continue. So analyzing your income and expenditure is very, very important before you start investing. Watch out for my next video for the next 2 steps.